what do I want to own that's going to be exposed or not exposed, and how exposed, and what is my risk of that portfolio to government policy going forward?
And so
this is the worst it's been in 50 years, right?
So the only thing that we've seen in the last 14 years is that they're really beholden to market. Yeah, you touched on a lot of big issues, and I wanted to segue a little bit because I have some macro charts that I think would be helpful for the discussion. Okay. On the inflation front, I would just add the following. I totally agree, government policy. Obviously, they came in big with stimulus checks. People got a lot of money they didn't have before, and they spent. That's hence my earlier comment about retail sales being 25% above long-term trend. It's just simply not sustainable, and that's how you get inflation on that front. I also will add, it's a long-standing point of mine, when all this happened, the Fed should have stepped back. There was no need to pile into monetary policy the way they did. In my mind, that created that just Uber-Tina effect. And part of that, by the way, part of inflation is also psychological, right? Because a lot of people are quitting their jobs. They sense they know there's inflation out there, and they demand higher wages, and that is filtering through. No, I'm not taking that job for X amount. I want more, and you will pay more because you must. So that's kind of part of the forward inflation expectation game. And yes, the Fed is limited in terms of what it can do there. And hence I want to bring in some key macro charts I think is really important for everyone to understand. I hope this works, so bear with me. The first one is just a recognition of where we are. Real Fed funds rate, due to the fact that inflation is so low, is so high. The fact is we're at the lowest real negative fund rate we've ever seen. And the notion here that the Fed with, let's say, 3-4 rate hikes this year is going to change that equation is a bit laughable, right? Because we're not, you don't fight inflation with a completely negative real funds rate. So they're so really far away from that. That's kind of my first point. And so
this is the worst it's been in 50 years, right?
Absolutely insane. Yeah.
Now, this is the nominal real yield. If you're a conventional investor and you focus upon CPI as the rate of inflation, and you focus on the bond index, then nominally you're looking at minus 6.7%. And so that's going to drive anybody that models the world that way to react to that with some delay, you would think.
Yes, and it just speaks to the intensity of this Tina effect. Where do you go? And that's why we've seen the most aggressive flush into stocks last year than we've ever seen before. But this is kind of an interesting game here. What's happening is in the fall, the Fed started to shift their tone, right? Because inflation, I mentioned it being psychological, but it's also political because we have midterm elections this year. And as you well know, there's a big political issue about how consumers vote with their pocketbook, and they're not liking what's happening on the inflation front. And so the Fed was forced to shift course from their transitory narrative. So far, they haven't done anything, but what you see is the bond market is reacting. We see it on the 5-year tips here is still negative, but it's moving more aggressively. So, and in the larger picture, this is the 10-year, an absolute massive technical pattern, inverse pattern. 2018, this is when everything kind of stopped, right? This was when the Fed was on its automatic balance sheet roll-off and Fed rate hikes, This is when markets dropped 20% because this entire debt construct we've built over the last 10, 15 years just can't handle higher rates, right? And so they started cutting rates in 2019 3 times, as you know. And then the COVID crisis hit and we had these record lows. Now this has broken out, and I think this is the problem we now see with tech and everything else. It's starting to react to it. If you're running 10, 12 years on nothing but cheap rates, and all of a sudden you're faced with a significant change in the yield construct, you're going to see a valuation adjustment. And I think that's what we're starting to see here now, at least at the very beginning part of 2022. And so the question then becomes, how far can you actually go? If this was the top, And by the way, this has been a long downtrend line since the 1980s, so this is already low, right?
Right.
If you couldn't handle... Go ahead.
What do you think will happen?
Well, what I think is, well, look, what happened here is the fact is we hit a trend back then, and the sensitivity, having added $7 trillion in debt in just the last 2 years, is going to be lower again. You know, the pattern says we go back up to here. I think that would be a disaster. I think there will be a point where, in here somewhere, where the Fed will again pivot, because that's actually what they've done every single time since 2009.
So the implication here, though, is that the bankers can't really allow interest rates to go back to, you know, short-term rates to go back, or 10-year rates to go back to where they were, right?
No,
they're going to control the yield curve. So,
yeah.
So the 10-year and the 30-year rates are really controlled by central bank intervention in the debt market, and they'll let it float up within a range, but then they'll intervene to keep it capped.
Absolutely.
They have been doing that, right, for the past. Well,
every single
long-term chart.
Every single time. I mean, I keep going back to that Powell quote from the Fed meeting in 2012, where he said, investors know we're here to prevent serious losses, right? And I think they've ever since then been beholden to markets. I'll show you a chart in a moment here as well. The other thing that's absolutely fascinating here is, you know, typically, when you raise rates, you want to be in a situation where the economy is improving and consumer confidence is high, right? That's what they even did in this last cycle here when they tried from 2015 onto 2019. And look at this, we have now the most massive recovery in terms of stock markets and everything else ever, yet consumer confidence has completely plummeted. We know why that is. It's because of inflation in the real economy. So consumers are not confident. I have no history anywhere where the Fed was raising rates when consumer confidence was this low. Just has never happened before. Not only this, and this is the real kicker now, growth estimates are coming down left, right, and center. I mean, last week we saw the Atlanta Fed drop their fourth quarter GDP from, it was 9.7% just at the end of November, now down to 5%. We see it in retail sales, we see it everywhere else. So in what history has the Fed had a lot of leeway to raise rates into a slowing economy? I mean, it is sad to say. I mean, we are now at this, you know, point where we had incredible earnings of all the stimulus, but now we have inflation that's impacting the consumer, and we see it filtering into spending. So the notion of inflation coming down, by the way, which is based on year-over-year figure, if just retail sales drops, then that solves the problem right there. And I think politically speaking, that's ultimately where they want to head, meaning they will do something here at the beginning of the year, but by the time midterms come around, they don't want to be in the political focus. So they'll probably stop raising rates right there. So all the expectations that are built in right now for rate hikes and quantitative tightening, I think that's a put that's being created under the market. If markets drop fast enough to a certain level, I think they will stop again. And by the way, just to add this chart here, this is mortgage-backed securities. They've added into a rising price. We talked 25% increases in housing prices. They kept adding here mortgage-backed securities. So they themselves have vastly contributed to this. And as we saw in the previous cycle, once they stop, then housing prices will level off as well. So that's just by them stopping doing that will actually impact housing prices for a while in 2021. So that's kind of where I'm at on that front before I add some more liquidity charts on that front. But I think they're kind of trapped on that front. I don't think they can do that much without upsetting markets. And I think that's kind of where we're at the moment.
So yeah, I mean, it's your thought is they overstimulated at the beginning of the crisis. Now they're creating expectations of aggressive contraction, and then they're going to back off on that as we go into midterms a bit. Is that what you're thinking, that third part?
Well, that's yeah, it's not, I guess my thinking based on every single thing we've seen in the last 14 years or so. I mean, just look at this liquidity chart here. Okay, this is basically what this shows is the S&P vis-a-vis the major central banks, and the blue line being the expansion phases. And what you clearly see is once the expansion phases stop, that's when you have corrective activity in markets. And we've seen that time and time again. In fact, I would argue with you, and I'll skip this chart here. This is going back to 2009, 2010. QE1 ends, we drop 15%, they drop a hint of QE2, then we get another rally. As soon as there's trouble, markets correct, we get another rally up. And then of course, that ends in the correction, we go back to QE3. I mean, that's unfortunately been the driver of financial markets here over the last 15 years. And look at the Fed pivot that we had in 2018, 19, right? Markets dropped 20%. And the Fed, who keeps claiming that full employment is one of their key mandates, along with price stability, cut rates 3 times when unemployment was at 3.5%, the lowest in 50 years. It made absolutely no sense. There was no recession in sight and none of the sort. So the only thing that we've seen in the last 14 years is that they're really beholden to markets. And my general concern is that because asset prices through ever more QE and ever more intervention have so far disconnected from the size of the economy, they have created this massive asset bubble that will be ever more sensitive to rate hikes and any quantitative tightening at this stage.